Thank you for having me here this morning to talk about the development and outlook of the global and Malaysian economy over the next 12 to 18 months. I think the choice of the picture here is deliberate and obvious. There has been talks about green shoots of recovery, and as they say, a picture is worth 1,000 words. This one worth about 5. The green leaf that's popping out there obviously refers to the green shoots of recovery, signifying the worst is over. But bear in mind it's coming out from the rather cracked, dried land, underscoring the risk that is still around us that could actually pose a bit of a problem with regards to seeing these green shoots of recovery turning into a full bloom. Although I guess my first slide here seems to suggest to you the slant of my presentation, I want to make it very clear here that my job description this morning is to make you risk aware, not risk averse. I will let the professional speaker subsequently to delight you with the prospect of making money in the stock market over the next 12 to 18 months. Anyway, let's start with the presentation proper. I think without a doubt, all this aggressive monetary policy easing, super expansionary fiscal policies done by central banks and governments around the world are having an impact, at the very least, number one, in reviving confidence among consumers, businesses, and investors, and secondly, providing what you call sort of a stimulus for the economic activities to stabilize. You can see from the two charts here, there has been a strong revival in confidence about the economy globally, and various indicators on global economic activities, as per the chart on my left-hand side there, seems to indicate that things are stabilizing, economic activities is picking up, or at the very least, the pace of declines has eased in recent months. Financial institutions around the world are showing or giving indication that the losses that have been racking up over the past 1 or 2 years ago are stabilizing. And at the same time, indicators on financial condition index, like that of the US, has improved amid a situation of more liquidity in the economy and the credit market and financial market, and narrowing interest rate spreads. We have dropped in market volatility and risk aversion, and of course this has contributed to the rally in the financial market, including the equities and to some extent commodity markets. But I think one of the perhaps the most encouraging indicators that's coming out with regards to the direction of the global and local economy going forward is actually from the leading economic indicators for the OECD countries, or the group of developed countries, BRIC economies, Brazil, Russia, India, and China, as well as East Asia, and not forgetting Malaysia. We are seeing actually the leading economic indicators turning around. And the message from these trends is that economies seems to be bottoming and turning around in the third quarter of this year onwards. As I mentioned earlier, there have been an aggressive interest rate cuts globally. The chart here basically shows on my right-hand side here, the global benchmark interest rate diffusion index shows you how much central bank has been very aggressive in terms of easing the monetary policy by cutting interest rate. So much so that the weighted average of a global benchmark interest rate now is at a record low of barely above 2% right now. And this, I think, is one of the key factors that's going to provide the stimulus for growth over the next 12 to 18 months. But I believe the most important drivers of a global and local economic growth, at least for the next 12 to 18 months, would be the huge fiscal stimulus being announced everywhere, including Malaysia. As you recall, Malaysia has announced 2 stimulus packages, in total about 67 billion ringgit. But at global level, when we do the checking and look at the numbers, overall, we estimated governments around the world for the next 2 years are going to spend about 2.8 trillion US dollars, equivalent to about 4.5% of global GDP.